Good morning and welcome to the Big Buzz Breakfast Club. Thank you so much for starting your day with us. We are super excited about today's presentation. Too often, because nonprofits are, many of you are tax exempt, there are just always times when we think that sales tax does not apply to us. And I know that we've even seen a couple of times when um, different regions have kind of included some taxes on some of our events, and we had to kind of really negotiate to get some of those removed. So we have invited a tax expert to join us today. So we will be talking about what nonprofit organizations need to know about sales tax, and it's going to be a really great presentation. Just a couple of housekeeping items. Want to let everybody know that the session is being recorded and we will be sharing it after this. Please do put any questions in the Q&A box as we go today. I will be trying to address questions, throughout the presentations with Diane. So happy to be able to field those in real time if there's anything you want to know additional information about. And then to manage closed captioning, please do feel free to use the button at the bottom of your screen. I hope that many of you are familiar with Big Buzz Idea Group, but for those of you who this might be your first time, want to just let you know that we know many nonprofit executives lack the time, staff, skills, and funding that they need to thrive. So Big Buzz Idea Group fills in gaps in management, marketing, and event services as an outsourcing partner so that nonprofit organizations can focus on the big picture and really position their organizations to thrive. Today, our guest is Diane Yetter, who is president of Yetter Tax and the Sales Tax Institute. I'm happy to introduce Diane and let her take over the floor.
Wonderful. Thank you, Melissa. I am excited to be here. Let me just share my screen here and get that set up. All right. Does everything look good, Melissa?
It looks real good. Thank you.
Okay, perfect. All right. So I am excited to be here with all of you today and to really kind of talk about sales tax, which is what I do every day, all day. So this is my life and certainly have a lot of information to share. We could talk for hours about this. So what I've tried to do is pull out kind of the most important issues that I see. And I'm happy to send the presentation to you, Melissa, afterwards. So if you want to send that with the recording, just a little bit about me. I won't go through all that. But what I want to do is just really start with, and I also want to set the expectations that this topic is going to just focus on sales tax. So that is my area of expertise. I'm not really an income tax person. So any questions that you have, if you can keep them in the sales tax realm, that would be great. So when we think about exempt organizations, these fall into a lot of categories, and I'm going to go through some of those categories in just the next couple of slides. But what I want to start with is the concept that exempt organizations, and under this, I'm talking about those that fall under one of the 501c categories under the Internal Revenue Code. So although we're talking about sales tax, and sales tax is a state issue, a state concept, in this area, we have to look to the IRS code for your federal classifications. So we'll look at that. But because that is a federal classification, states are not bound by anything in terms of what they are limited or have to do, a requirement when it relates to sales tax. It certainly impacts the state income tax consequences, but not the sales tax. So state legislators can choose who they want to tax, and that includes not only decisions about whether or not to tax not-for-profit organizations, charitable organizations, educational organizations, but even whether or not they tax sales to themselves to the state government. The only organization, if you want to call it that states are prohibited from directly taxing is the federal government. But we do have states like California and Washington that tax sales to themselves. And then some of the states that generally don't exempt or don't provide a sales tax exemption for not-for-profits include California, Nebraska, North Carolina, North Dakota, and Washington. There's a few others. But those are the states, and California is always one that kind of jumps out at people with that. And then there are others. So some of the states make a very broad exemption, everyone that is a 501c3. Sometimes it is a broad type of exemption. Everyone who is an educational organization may be exempt, and that may be whether they are a for-profit or a not-for-profit. And then there are some states, Arkansas is an example, that has a very specific list of organizations that they exempt. So they don't broadly exempt organizations, but they want certain ones. So you might see the Red Cross, you might see the Girls and Boy Scouts, you might see veterans organizations, but not generally different types of organizations. So it is very much a state specific investigation that you have to do. So when we think about for states that do offer exemptions, how do you go about doing that? Well, there are very specific requirements that generally have to be met. And so the first thing is it may be tied to your not-for-profit status. And so typically the exemptions that exist are limited to 501c3 organizations. So those are typically religious, charitable, scientific, for public safety, literary, educational, and other specified purposes. And they must be organized and operated specifically for those purposes. And then other states may tie it, as I mentioned a moment ago, to a certain type or purpose of the organization, charitable, religious, educational. So we do see states that do both of those. In some states, Ohio is one of them. An exemption at the federal level means an automatic exemption at the state level, while other states are going to require an application. We're going to talk about that in a moment. So what are some of the other federal classifications other than a 501c3? So I know that Melissa shared with me, we've got some condo associations might be joining us, some industry associations similar to NABO, for example. And those are typically not 501c3s. Those are probably going to fall under condo associations are considered C4s as associations of employees. It's also of homeowners associations are included in that. Business leagues are typically your business associations, social and recreational clubs. If any of you represent country clubs or some of the business clubs downtown Chicago. Fraternal societies, so fraternities and sororities, but also things like VFW halls and some of the other fraternal types of societies will fall into that. So it's important to know what your federal classification is, because that is going to help you make the determination as to how you are classified for sales tax purposes. So when we think about how how an organization determines whether or not they qualify for a sales tax exemption, most of the states are going to require the organization to actually apply to the state Department of Revenue in order to get that specific exemption. So it is very rare that to claim a sales tax exemption when you buy things that you simply give a copy of your federal IRS 501c3 letter or C letter. But usually you're going to have to apply to a state and get a different number or a different type of letter. So I looked at the Midwest surrounding states for this. So Illinois, Indiana, and Wisconsin are all going to require the organization to fill out an application to be classified as a sales tax exempt organization. But Iowa, Michigan, and Ohio will not. Those are states that your IRS classification is generally going to dictate your status. And in Illinois, Indiana, and Wisconsin, you are going to receive either an exemption number. In Illinois, we refer to it as the E number because it's a number that starts with the letter E, for exempt. And then it has, I think it's 8 numbers after it. And then Indiana just made a change to their policy and how you go about doing that, but you have to have a login to their, it's called InTime, INTIME, which is their online sales tax portal, their online state portal. So you have to have access to that, and you'll go in, and that's where you will download your certificate after you have applied. And then Wisconsin is going to give you a letter. And so those different sorts of documents is what you will have to present to your suppliers when you are buying things that qualify for the exemption. So the next thing I wanted to cover, excuse me, is that there are differences in how the states treat not-for-profit organizations in terms of when does the exemption apply? Does it apply on your purchases, or does it apply on your sales? And so what most situations or most states are going to say is that the exemption applies to your purchases of items used in conducting your exempt organizations. So for ease, let me just use a school as a good example. So when a school buys things like textbooks or desks or computers or supplies, school supplies, those sorts of things, it's very clear and easy to see that there is a direct correlation between those items and the mission of the organization. The mission is to educate students, and you need those things in order to do that education. But it also will include things like sports equipment. So when you are buying items that are used in PE, but also things that might be used for the football team or the cheerleading team, those usually are going to qualify as long as they're purchased by the school. And the reason for that is part of the educational experience is team building and camaraderie and learning how to work in a group and athletics and things like that. So those typically are also going to qualify. What's not going to qualify is when the booster buys things. So if there is a separate parent boosters for the football team and they're going to go buy the scoreboard, those sorts of things often are not exempt because the booster club is usually not exempt. When we get into things like the parent-teacher associations, that can vary depending upon whether or not they are actually part of the school or if they are a separate organization. So one of the things that's really important about sales tax and understanding that is what is the official legal classification of these organizations. So sometimes we see that those parent-teacher organizations are actually just a good way to think of it is a division of the school versus it is a separate legal entity with separate federal ID numbers, separate bank accounts, all of those sorts of things that are completely separate. So when we,
And I have a
yes,
question on that.
yes,
So is there a reason, I mean, so could or would most parent-teacher organizations that might be separate be able to file for their own exemption, and they would have to do that independently? Or are
correct.
they generally, they don't fall under that classification at all?
It depends on how they're organized. So sometimes the parent-teacher organizations are 501c3s because the purpose is to support the educational mission of the school. So they very well may qualify, but they have to go through and get classified by the IRS as a 501c3. So if they
Excellent.
take those steps and do that, then they usually can qualify, but they have to have their own sales tax ID and exemption authorization from the state.
Thank you.
Sure. Now, on the flip side, not for profit organizations that make sales may not qualify as an exempt seller. So let me use the example of a gift store in a hospital. So the hospital may be exempt, but the gift store that is set up, even if it's part of the hospital, not like part of the auxiliary board or anything like that, but it's actually part of the hospital. And maybe a better example is the cafeteria. So if the cafeteria is open to the public and it isn't just providing meals for patients, then the reason that the states typically say they need to be registered to collect sales tax on their sales is because they are competing with for-profit organizations. So at that point, when an organization is making sales, they need to be registered as a retailer and will be classified as a retailer under the sales tax laws. And then the items that they purchase that they're going to resell qualify for what we refer to as the resale exemption. So a concept with sales tax applies on the sale to the final user or consumer. So if we think of that hospital buying the ingredients to make the food that it's going to sell in the cafeteria, they are going to buy all of those items exempt under what we call a resale exemption, which is a different type of exemption document that you would issue to your suppliers. But then you collect sales tax on the sales of those food items in the cafeteria or gift items in the gift store. And so that's where an organization like a hospital would have, if we're talking about Illinois, they would have an E number that they give on purchases of things that they use in providing their medical services. So hospital beds, linens, computers for the staff, all of those sorts of things. They would purchase those with their E letter, but the food that goes into the cafeteria or the items that go into the gift store, those items are going to be purchased without tax, but for a different reason under their resale exemption. And then they are going to charge sales tax on the sale of those items and then remit that tax to the Department of Revenue. So that's how we look at it differently. Now, what constitutes the different sorts of sales? I'm going to talk about that in just a moment. But what I want to do is dig into a little bit more now purchases by exempt organizations. So, Melissa, I focused here on Illinois since I think that's the bulk of the people attending. But certainly, if there are people that have questions about other states, if I don't know it off the top of my head, I have a couple resources I can refer to while we're on the call. I can certainly come back and provide those answers. So this is how the Illinois rule is written. So it says a sale of tangible personal property, which is what sales taxes typically apply to, which think of it as anything that you can pick up and run away with, even if you need a forklift. So something that isn't attached to real property, something that isn't a service, and something that isn't an intangible. So a sale of anything like that to a corporation, LLC, society, association, foundation, or institution. So anything that is operating, think of it as an organization, as long as it is organized and operated exclusively. So that's going to be a key component for charitable, religious, or educational purposes is exempt from sales and use tax, and the transfer of that any property as an incident to rendering the service by such entity is also exempt. So if I am a service provider and I am providing some sort of service and there's an incidental rendering of that item to the organization, there is a concept that we refer to as a flow-through exemption. So if I am doing work for a not-for-profit and I have to give them something physical, I can get an exemption as if I am that exempt organization. So that is what qualifies. Now, how do you document that? So to qualify for the exemption, the organization has to have an active exemption number. That's that E number that I mentioned earlier, issued by the Department of Revenue. And so it requires an application to the Department of Revenue in order to get that E number. And then there's a rule that if you have multiple subsidiary organizations, more than 50, so we see this sometimes with a school district that may have 50 different schools. And this is the PTA organization, Melissa, that we talked about. If the PTA organization is part of the school district, they may issue one number to the school district rather than one number to each school independently. So that's where that would come in. And then these applications, they expire every 5 years. So you do have to go in and renew that. And the renewal is 5 years from when the organization is granted that number. And then you give a copy of that e-letter to your suppliers. So if you just got a new supplier today, but you've had your e-number for 4 years, you're going to have to give that supplier a new letter in a year, not in 5 years, because you're going to get a new letter every 5 years. But now, if you are making sales by this type of same organization, so an exclusively charitable, religious, or educational corporation organization, they are generally subject to tax when they do that. So this is the hospital, gift store, or cafeteria that we talked about. But there's a couple of exceptions. So exceptions are sales to members, students, patients, or inmates primarily for the purposes of the selling organization. So what this means is if the school sells the Chromebooks to the students, they wouldn't have to charge tax on those Chromebooks that they're selling to the students, because it is just for the purpose of the school to be able to provide the educational purpose. If any of you have gone to the hospital, you may be charged for slippers or socks or a bedpan or different sorts of things like that. Those the hospital is not going to charge you tax on because it's for the purpose of providing your health services. Sales of property by persons not organized for profit that do not compete with business establishments. So this is where we get exceptions for Girl Scout cookie sales or the calendars, or things that the school might be doing a fundraiser, and they're not really, yes, can you go buy cookies in a grocery store, but they view that the kind of the purpose of the Girl Scout cookies isn't really cookies, as I sit staring at a box of Girl Scout cookies on the table where I am right now, because my batch just got delivered to me. But it's really the fundraising purpose. So those are not going to be taxable. And then the other reason is occasional sales. So these will be, you have a rummage sale once a year, twice a year as a fundraiser, dinners, socials, similar sorts of things. The carnivals, bake sales, bazaars, those sorts of things. If it's no more than twice in a calendar year, then you are not going to have to be a registered retailer and collect tax on those.
Diane, when
Yes.
we are talking, I know that we have a couple of clients that have social justice enterprises.
Okay.
As we kind of think through something like that, one in particular makes candle sales. All the candle sales go back to fund the program.
Mhm.
I imagine that might also be case by case, depending on how things are structured or set up. Is that true? Or what would you kind of say about an instance like that?
So what I would say is if the candles are available for sale year round, that's probably going to require a retail license. And I'm assuming they're in Illinois, Melissa.
They are.
Okay. So if candles are available year round, then that is not going to be this occasional sale. And one of the things that they really look at is the infrequent. So the Girl Scout cookies typically have a limited period of time when you can buy the cookies or the calendars or those fundraisers. So if something is available year round, they have a website where people can buy the candles. I think Illinois is going to consider that to be in competition with a for-profit organization that sells those candles. And so that's where, if we look at this, you know, gift shops, rummage stores, things like that operated by charitable or religious organizations are subject to tax because it's that ongoing type of sale. So I think the candles probably would fall into that unless it's just they have a 1 month, candle sale and they do all
Right.
their fundraising in that very limited period of time.
Great. Thank you for covering that example because I know that's getting to be more and more common for
It is.
organizations to kind of in their
Mhm.
fundraising initiatives. So thank you.
Yes. So then we've got examples of these infrequent sales, the cookies, the candy, the Christmas trees. It's infrequent, and this is really kind of the other key component. The dominative motive dominant motive of the purchase must be the making of a donation to the organization rather than the acquisition of the property. Now, certainly it's hard to argue that when you buy a Christmas tree, you're not looking for the Christmas tree, or you're not looking for the Girl Scout cookies. But there's this little bit of latitude when it is that infrequent. And then there are a couple of carve outs that even if it is only once a year or twice a year, it you sell hats, greeting cards, or other items for which the dominant motive is the acquisition of the property rather than as a token for the making of a donation. Then that is what is going to be taxable. So this could be the other area, Melissa, that the candle is because you really want that candle rather than the donation. Now, in some other states, you will see that twice a year rule that I just talked about with Illinois, that is the bigger determining factor. So in Tennessee, if they are regularly engaged in business of selling property or furnishing taxable services, they must register for their sales and collect tax on their sales. In some, it is going to be limited to either a number of times, and we'll talk about that in a moment. But then, what we also see some some states say is that organizations may not need to charge tax on the sale, but anything that they buy that they're going to sell, they don't get their exemption on the items that they purchase. And so that's what Tennessee says here. So if you are an exempt organization that is not regularly engaged in the business, so let's talk about the Christmas tree sales by the Scouts, they don't have to collect tax when they sell it, but they do have to pay tax on it when they buy it. That they're going to resell. So, in essence, what they're doing is they are saying tax is going to apply on the value of the item that somebody that wasn't making a donation would pay tax on. So if a Christmas tree would normally cost $50, but the Scouts are going to sell it for 75, they say the $50, we want the tax on that $50, but the $25 donation is not going to be subjected to tax. We also see this a lot with the school sales. We did a research project a number of years ago for an organization which was the supplier of things like the candy, the cookie dough, the wrapping paper, all of the stuff that the kids are doing fundraisers for. And they often had to collect the tax from the schools that they were selling these items to. And part of the rationale was they didn't want the kids having to figure out how to collect the sales tax and having those odd pennies on the sales. They wanted, we're selling this for $10, and then the school paid tax on the $5 price of the wrapping paper, and then the $5 donation didn't end up getting taxed. So we see that happening in some states. Now, when we get into things that might be bought by a not-for-profit for events, so catering and other event related costs, here it is really going to vary based on the state. A lot of times prepared meals. So if you were to purchase the catering items, that those may not qualify under an exemption, even if the organization is otherwise exempt from tax. And then, in some cases, it must be that there isn't a separate charge for the catering event, the catered event. It must have other purposes with it. Sometimes, if it is catering provided in conjunction with a meeting, where the main purpose of the event is the meeting and not the food. So there we see things like if it's coffee and donuts, something what the states use the term de minimis, then that may not qualify, or that may qualify for the exemption. The other thing that typically needs to apply for any types of purchases by a not-for-profit organization is that the purchase must be made directly by the organization. So if you have a member that goes out and pays for something and then the organization reimburses them, that is not going to qualify for the exemption. So the way the states typically write this in their statutes is it says the purchase must be made directly by the organization and payment must be directly by the organization. So where I've seen a lot of issues come up with this is I've helped some country clubs, and they are getting hit with assessments because they require the member to make the payment if they are sponsoring the organization event. And so that loses the exempt status. So in that case, the member has to sponsor if the country club will allow that. But then the purchase order, the event contract needs to be directly with the exempt organization. They have to be the one listed on the event order form, and then all of the payment must come directly from the organization. And I see a question came in, Melissa. Even if the person brings the tax exempt form with them, yes, even if they bring that tax exempt form with them. There are some states that even say if something is paid in cash, then it doesn't qualify. But the states, Illinois particularly, is where I've worked with a number of country clubs on this issue. They get the check from the member, and they have the exempt form with it, but the member signed the contract. The name of the event is listed as the not-for-profit event name, but all of the paperwork, everything shows that the event was arranged for and paid by the member and not by the organization. So you have to be very, very careful about that.
I want to add in there, Diane, that
Mhm.
we have seen one particular organization that really this is where they got themselves into.
Mhm.
I mean, they had to pay a lot more than they should have had to pay
Mhm.
because they hired a service provider and the service provider, did the contracting
Yep.
and therefore they were not exempt from any of those additional
Mhm.
taxes. And so the nonprofit, in not watching that, and not realizing that until it was too late. I mean, I've seen
Mhm.
organizations pay, $3,000 to $8,000 more than they needed to pay.
Exactly.
And so that is all money that can be kept in their pocket if they're
Mhm.
paying attention to this and really staying, working with their suppliers appropriately so
Exactly.
that they are directly paying and being able to use that exemption. And I encourage everybody to always be checking those agreements, reviewing the invoices from your vendors and your other suppliers and anybody you contract with.
And there are ways, Melissa, that you could, if the service provider is the one that you really want to manage all of that, there are ways to set up legal agency arrangements. So think of an ad agency is often out negotiating contracts for things like media spend, and placements and things like that. And there are ways to legally name an organization or a company. I'll use that instead of an organization, where the organization can name this service company as their legal agent. But then how they contract with providers has to be, Diane's service company as agent for ABC not for profit organization. And there are ways that you can do that, but you have to have all of the paperwork and your contracts have to support all that. And then in essence, the status of the not for profit flows through that service provider up to the supplier.
I love that you brought that up. That's exactly how we are structured in most
Mhm.
of our agreements and most of our projects
Oh,
because
great.
so much of our work is around events. And so when
Mhm.
we have those really large events, we sign everything as an agent. It's written into our contracts that
Mhm.
are serving as an agent and that both parties agree to that terminology. And so we do have all of that documentation and that official paper trail.
Wonderful. That's great to hear, Melissa. So here's just I wanted to throw in a couple of other state examples. So in Virginia, the not-for-profit organizations, including state and local government entities and churches, can use their exemption to purchase prepared foods, catering, and related services provided in connection with the sale of food exempt from sales tax, but they must follow these use and consumption tests. So, in order for it to qualify, so these are events in Virginia as an example of how some of the states can differ. The provision of the meals or catering service furthers the purpose of the organization. So, a good example would be having a homeless kitchen, a kitchen for homeless to feed. The church may have a dinner once a week for the homeless people to come in. The charge is billed to and paid for by the organization from the organization's account. So this goes to what we were just talking about, that direct payment. And the organization determines to whom, how, and when the meals are served and consumed. So I am going to have a dinner for homeless people, and it is going to be on Tuesday night. It is going to be a buffet, and in order for them to be served, they must be, how they qualify them as a homeless individual. So that's what Virginia says, but you can see what I've bolded there, that billed to and paid for by the organization is really one of the key components. In Illinois, if the purchaser is incorporated primarily to provide entertainment, social, recreational, or athletic facilities, then it does not meet the requirements. So, Illinois, it must be, as we said a few slides ago, exclusively for charitable, religious, or educational purposes. So, if really their primary purpose is entertainment, social, recreational, or athletic, so country clubs, as a perfect example, they may have some charitable components, but their primary is not charitable. So they are not going to qualify. So even if for some reason they are a 501c3, they somehow got that classification from the IRS, Illinois is not going to certify them as sales tax exempt. And then here, the other one is fraternal benefit societies, where they are primarily organized to provide different forms of benefits to their members, such as different sorts of fraternal benefit societies, even if they say they are exclusively charitable. And then here are our business types of clubs. So bar associations, medical associations, lion clubs, Rotary clubs, Chamber of Commerce, and other professional trade or business associations. So the reason for this is because the primary purpose of those organizations are to protect and advance the interest of their members in the business world. So they say, even though they may have some charitable or educational work, they are really not organized exclusively for that charitable or educational purpose. And then you've also got American Legion, Veterans of Foreign Wars, AMVETS, Daughters of American Revolution, and other similar not-for-profit patriotic organizations. So again, some of these are definitely 501c organizations. They're probably not C3s. And so this is that classification becomes so very important. And then, as I said, those occasional sales, some of the states are going to limit it to the number of sale days. We've also seen a few states do it based on the dollar value of the sale. So as long as the total amount generated is less than $50,000 or $100,000. And then, as we talked about with the Tennessee example, sometimes the organization is going to be required to pay tax on the purchase of the items to be sold. So when it's a dollar value of the limitation, sometimes the number of days is not part of that. But we do have some states where it will be a combination of number of days or dollar values. And sometimes it's number of events instead of number of days. So here's the Florida. If it's a not-for-profit, charitable, civic, educational, neighborhood, religious, volunteer firefighter, or other not-for-profits, if the sale occurs twice or less during a 12-month period, but here they are required to pay tax on the items that they're going to resell. They are not making the sales on a commercial premise where other businesses are making taxable sales. And it does not involve a licensed vehicle. So there's often carve outs for those sorts of things. So if there is a rummage sale happening in the church basement, and it's less than twice in a 12-month period, in Florida, they're not going to have to be registered. But if they do that sale at or let's say a craft fair, and there are other for-profit people that have tables at the craft fair, then they are going to have to collect tax on that because they are on a commercial premise. So that's going to be a key in Florida.
I
And
have
then,
another question,
sure.
Diane. So if we go back to kind of like that social justice enterprise making candles, and so as a matter of fact, they do have online candle sales year round, like you were talking about. And so if somebody were to purchase, let's say that they live in Florida, for example, but the organization is in Illinois,
Mhm.
um, what requirements or rules do they need to follow for a situation like that if sales are outside of their primary state?
That's a great question. And I'll briefly answer it, but we could do a whole nother webinar on that one, Melissa. So, historically, and I'm talking, although it's now becoming a little bit of history, in 2018, there was a US Supreme Court decision called Wayfair versus South Dakota. So if you've heard that thrown around at all. Um, that was a decision that changed when is a business required to collect tax on what we call remote sales. So sales outside of the state where I'm organized. And at this point, every state in the US that has a sales tax has passed a law that says if an organization, if a company making sales exceeds a certain threshold, a level of sales into a remote state, then they are deemed to be a retailer that is required to register and collect tax. So the rule in Florida is there has to be more than $100,000 of sales into that state, as long as there's no physical presence in the state. So if that Illinois organization sells online, if they exceed $100,000 of sales in a year, so it's usually a 12-month period, most commonly a calendar year, then they would have to register and start collecting tax in Florida. However, in Indiana, the rule, I'm sorry, not Indiana, let's do Michigan, because Indiana just changed their law. Michigan, it's more than 200 sales. So if they have more than 200 invoices, 200 people that buy candles in Michigan, they would have to start collecting tax in Michigan. So that rule varies from at the lowest end, it's $100,000 or 200 transactions. Then we have $100,000 only. We have two states that have a $250,000. And then, luckily, the three largest states in the country, California, Texas, and New York, have a $500,000 threshold. Illinois, although for your organizations that are in Illinois, they have a physical presence, so they have to do that on sale one. But Illinois is one of the 100,000 or 200 transactions.
Very interesting. Thank you for sharing.
Sure. Um, all right. So in Wisconsin, as a neighboring state, neighborhood associations, churches, civic groups, garden clubs, social clubs, and similar not for profits can claim an occasional sale exemption on their sales of property, including admissions to an event. So Wisconsin has a fairly broad one. Because we have social clubs and civic groups, which in Illinois they were not considered not for profit. And so in Wisconsin, the event may not involve entertainment, which costs more than $50,000 for the performance, unless the access to the event can be obtained without payment of an admission fee. So if you have a performer come to perform a concert, and that is, oh, I don't know, let's say Taylor Swift, you get to come. But you have to pay her $1 million to come for your event. That's not going to qualify unless your event is free for everybody to come to. But if they have to pay for a ticket, then because that $1 million payment to her exceeds the 50,000, you're not going to be able to qualify for that exemption. And then the organization conducting the event must not be engaged in trade or business and must not have a seller's permit unless their only permit is to do bingo. So most of the states, because bingo is quasi gambling, they allow it for these not for profits, but it requires a license. All right, and then donations. A lot of people, ask about, or they think, "Hey, I am buying something, and I am going to donate it to a not-for-profit. Do I get an exemption on that item when I buy it?" So, Melissa, I know I was just at the NABO event with you last week. There were a lot of organizations that provided wonderful gifts for the raffle. And so a lot of people say, "Oh, I'm donating this to a not for profit. I don't have to pay tax on when I buy it." No, that is not the case. So, donations of tangible personal property, when purchased by the donor, because the exempt status is the donee, not the donor. So, donors, unless they themselves are a not for profit, are always going to pay tax on the items that they purchase that then they donate. And so that tax needs to be paid at time of purchase, or there are rules in all the states that if you bought it without tax, that you have to pay it directly. Now, there are some very isolated exemptions. So, Virginia actually has an exemption for donations to property within their state. We also see, after times of natural disaster, one time limited donations. A number of years ago, when there were the atrocious floods in Missouri, we saw an exemption for building materials purchased specifically to rebuild homes that were damaged with the floods. So we will see some isolated, very short term. So I think that was for 6 or 9 months, that was there, and you had to prove that you were repairing something damaged in the flood. So you will see some of those isolated things that will come up. The question, the donation of services. So that is going to depend on whether or not the service is taxable or not. So in Illinois, very few services are actually taxable. But if the service provider purchases items that then they use in providing that service, typically there won't be an exemption on those items that they use and consume themselves. There may be an exemption if the items are transferred to the not for profit. Idaho is a state that generally does not have an exemption for not for profit or charitable organizations, but they do. We often see specific transactions that could qualify. And so here they have an exemption of donations for food banks and soup kitchens of items used in the growing, storage, preparation, or service of food. And then also purchases and sales to the Idaho Food Bank of the actual food products. And then also similar to the Advocate for Survivors of Domestic Violence and Sexual Assault. So Idaho, this is a really great example, is why I wanted to put it in here, is states that generally don't have any broad exemption for not for profits often will have these very, very unique carve outs to support specific targeted social justice types of organizations. So we do see that on occasion. And then the what I really wanted to kind of wrap up with is when an organization, particularly, I want to talk about Illinois because it is a unique one of the states that have some of these unique rules. Is that if you are an Illinois organization and you go to another state to do an event, or if you are an Indiana organization and you come and have an event in Illinois, you cannot assume that because you're exempt in your home state, that the state that you go to will have an exemption. So if you are an organization that puts on events and you go to events in other states. So if you are a national organization and you go to another state to do that event, you need to know what the rules are in that state where you're going to hold the event. So if an Illinois exempt organization goes to California to have an event, their Illinois exempt status is going to carry zero weight in California. First of all, because California doesn't exempt California organizations. California doesn't provide any sort of sales tax exemptions to organizations in California. When that California organization, if they were to come to Illinois, they might qualify, but they have to file for and get that Illinois E number in order to do that. Some of the states say if the state you came from would not honor an organization from our state, it is unlikely they will grant that exemption. So I'm pretty sure that that California organization, when they come to Illinois, Illinois is not going to give them an E number. But Indiana, which does provide exemptions for exempt organizations in their state, when they come to Illinois, they can qualify, but they have to file for and get that E number. A couple of the states that will not honor organizations going into their states, even though they have exemptions for organizations in their state: Georgia, Nevada, Oklahoma, and South Dakota. DC is also one that's very, very strict, and a lot of organizations go to DC for national events. In order to get an exempt status in DC, you must be a DC organized organization created. So you have to be originally chartered in DC in order to get an exemption from the DC sales tax. So that is probably the strictest one that I know of. And so you really are limited with getting exemptions there. And then, as I said a couple times throughout here, California generally does not provide an exemption. There are a couple of small isolated ones, but very isolated. And then Hawaii is a state that taxes everything and everyone. So everything there is going to be taxable. So that is what I have for you today, Melissa. Are there any other questions that have come in?
The other question that I would ask about is, I know I find in Illinois it can be a little bit at different levels of the government within the state. It can also be different. I'm not sure if we could maybe talk about that a minute as well,
Sure.
relative to county and or city taxes.
Sure. So when we're talking about sales taxes, all of the sales taxes, with the exception of something I'll talk about in a moment in the city of Chicago, when it is a sales tax, those are all going to be treated the same. So in the state of Illinois, all of those taxes are administered by the state of Illinois. So the 6.25% state tax, the county tax, the city tax, and the special purpose, predominantly transit taxes. Those all are administered by the state of Illinois, and those all follow the same rules. If you have an e-letter from the state of Illinois, then that is going to cover all of those taxes. However, many cities have separate meals taxes. So if you're doing a catered event, and I don't know if Melissa, maybe that's where you're running into the issue. Some of those cities do have special meals taxes. In addition, the city of Chicago has the Metropolitan Pier and Exposition Authority. That one happens to be administered by the state of Illinois. And I can't think of any reason why the e-letter is not honored for that, as long as it meets the other criteria that we talked about with Illinois. But I do know that there are other cities around the state. I had this issue with some of the country clubs that I've worked with, that the exemptions did not flow through to those meals taxes. So I do know that you have to look at that separately. The
Yeah,
city of
sometimes we're finding that it's just interesting. It seems like lots of times in our this day and age, I
Mhm.
guess, that there are additional taxes popping up.
Yes.
And so even if they're not exactly sales tax, I think I've seen a couple of equipment taxes here and there.
Mhm.
Sometimes there are some labor taxes. So it's just interesting. And I generally, right, we always try to present our E
Yep.
numbers when we can, and try to be able to minimize those as much as possible. And most of the
Yeah.
time it works, but occasionally it doesn't.
Yeah, as long as it's generally, if it's administered by the state. So Illinois generally does not tax labor charges. Let's So if somebody's charging you tax on labor, it's probably under the sales tax, and it's because more of what they're doing is for goods. Occupancy taxes are separate, but I think those will take the E number. But again, it has to be paid directly by the organization. So if it's an employee that is traveling and they're paying on their own credit card and getting reimbursed, it's not going to qualify. But if it's a company credit card that they're using, then it would qualify. So it goes back to that directly paid by. And then the one kind of real outlier is the city of Chicago imposes a lease tax. So if your equipment charge tax that you're talking
Mm.
about, Melissa, was for the rental of a piece of equipment, that is a separate tax administered by the city of Chicago. It's a 9% rate. The city does honor the Illinois E number for that. So even though it is a separate tax authority, they are one that does honor the Illinois E number for that exemption.
Yeah, thank you for verifying because a lot of our events do have certain equipment that comes in, and I do think
Yep.
we've seen that pop up here and there.
Yes.
So,
Yes.
well, I am not seeing any additional questions, and it does seem like we're running right up on time. But
Mhm.
Diane, I can't thank you enough. I think this is just a lot of really valuable information that is not often clarified. I've not seen this information really shared or presented at this level of detail, and just the nuances of all of the different states and how that applies. I personally have found today to be incredibly helpful,
Oh,
and
good.
I hope that our guests have as well. And thank you so much for sharing your time with us this morning on this very important topic.
Happy to. And if anyone has any questions, as I said, I'll send Melissa this slide deck, and you can feel free to send it out. Our website, salestaxinstitute.com, which I guess of all the things that we have on there, we don't have the website. We have a lot of great resources out there, including a lot of information about that economic nexus that I talked about. We have a chart with that. So definitely feel free to reach out if we can be of help.
Thank you so much, Diane. Have a
Thank
great
you.
day.
You too.